Are you considering your retirement options, weighing up what annuities are, or whether you should go with drawdown as a retirement option? Well, in this video, we're going to explore in a bit more detail what annuities are and look at whether it's a good option for you and how much income you may be able to get with an annuity if you go down that route. We're going to focus on lifetime annuities and ignore fixed term annuities as they could be a video in itself. So an annuity, it's a retirement option that is often referred to as a guaranteed income for life. It's often called this because the income from an annuity is usually paid for the rest of your life. Essentially, you swap your defined contribution pension fund in return for a guaranteed income. As the income from an annuity is guaranteed, there's no investment risk, and so this retirement option can be useful for those who are naturally a bit more cautious or, unlike income drawdown, don't want the hassle, responsibility, or don't have the inclination to manage a pension fund and being responsible for the income strategy and the investments. So annuities, they became something of a dirty word when the pension freedoms were introduced in 2015 and flex access drawdown was introduced. Along with ultra low interest rates, which influence the amount of income available to you from annuities, sales of annuities plummeted in the preceding years. However, as interest rates have risen substantially post-COVID to combat inflation, they are a lot more attractive, as we'll see in a minute, and now a genuine competitor to drawdown. We're going to now consider a few factors which may or may not make the prospect of an annuity more appealing to you. So an annuity, it can be a good option for those who are uncomfortable with investment risk and managing a pot of money, as the income, as we've said, is guaranteed and paid for life. In contrast with drawdown, the remaining pension fund is usually invested and so will be subject to investment risk and the whims of financial markets and volatility. There's also a risk that investment returns are lower than you expected, and or you take too much income from your drawdown pot, or you live longer than expected. Well, you could run out of money. Although stock markets have historically rewarded investors over the longer term, they can be very volatile in the short term, as you can see with the past returns of a 60-40 portfolio, having lost 20% or more on 4 occasions since the millennium alone. If you're uncomfortable with volatility and the prospect of seeing your nest egg go down by as much as 20 or 30% or more, and this fills you with dread and could cause you to panic and sell your investments during a crash, a stock market crash, this can have catastrophic effects on your retirement planning. This is because you would be crystallising what were paper losses up until that point you sold your investments. I've previously spoken about the war story I've experienced firsthand as an independent financial advisor. So cast your mind back to March 2020 and COVID-19, the stock market was in a precipitous fall and suffered heavy losses as the news was full of sensational headlines and it looked like the global economy was about to shut down. A client who was a retired doctor, believing it was the end of the world and the healthcare system and the stock market had further to fall, he was adamant he wanted to sell his portfolio and buy back in when prices of assets got cheaper. Lo and behold, despite our warnings, he sold at the bottom and the stock market recovered in rapid time, meaning not only did he crystallise those severe paper losses, but to add salt to the wounds, he bought back in at higher prices. Drawdown can be quite a complex area and you're responsible for the investment decisions of your pension and also how much income you can take from your pension. If you have little knowledge in this area and you've got no inclination to learn this information, then an annuity may be a good option for you. This is because an annuity will just simply pay you this guaranteed amount of income. This means you don't have to worry about a whole raft of issues which you would with drawdown, such as your investment strategy, sequence of returns risk, what's a sustainable amount of income to take, and worrying if you have enough money. What highlights the risk of drawdown is that in a study by the FCA in 2021, which I've banged on about before, they found that the average person in drawdown was withdrawing 8% of their pension a year. If these figures are correct, this is really quite scary, as these numbers are highly, highly unlikely to be sustainable over a retirement of 15, 20 or 30 years or more. You could of course pay an IFA like myself to manage your pension on your behalf, but this would add a further layer of fees. We touched on this already, but annuity rates are intrinsically linked to gilt yields, UK government bonds, which are heavily influenced by interest rates. So the annuity rate that you get is simply the annual annuity payment divided by the value of the pension used to purchase it. So as interest rates were at rock bottom for much of the past decade or so following the banking crisis of 2007, 2008, the prevailing annuity rates were relatively low, as you can see on this chart now. As interest rates increased dramatically post-COVID to combat soaring inflation, the income from annuities have increased substantially and now provide a meaningful form of income, and this retirement option can now be a viable alternative to drawdown. So as an annuity pays you a fixed amount of income, you need to ask yourself, how much flexibility do you want with your retirement options? Because once you do purchase an annuity, it's usually not possible to change your decision or the amount of income that you take. This means it's not possible to shape the income around your circumstances. So many people, for example, often prefer to take more income during their active years whilst they have their health and will spend more on holidays, etc., before this then reduces as they approach what I like to call later retirement. Equally, as the state pension is currently payable from 66, rising to 67, many people who retire before this age like to take more money from their private pension before reducing it once the state pension kicks in. Unfortunately, with an annuity, you're not going to be able to do that. So another consideration when coming to retirement and considering your options is that when you die, an annuity dies with you. Although it's possible to add a survivor's pension, which is usually a percentage of the annuity payment at the date of the annuitant's death, such as 50%, this will usually lower the initial annuity payment compared to a equivalent annuity that didn't have a survivor's pension attached to it. In contrast with drawdown, your beneficiaries can usually inherit your remaining pension. So if you die before the age of 75, they can usually inherit the remaining pension tax-free. If you die after age 75, well, they can again inherit it, but any withdrawals that the beneficiaries take will be subject to income tax at their marginal rate. So if you've got a family and you wish to provide a legacy for them after you've gone, this can have quite big implications for you. Likewise, if you opt for an annuity and investment returns are much better than expected, you wouldn't benefit from this investment growth, although this is impossible to predict in advance, and the opposite would be true, investment returns were worse. Another factor to consider is what other retirement income you may have. So if you're lucky enough to have perhaps a defined benefit pension, and or maybe your state pension covers your core expenditure or the bulk of it, well, you could argue that an annuity makes less sense, as you may not need the security of a guaranteed income as your other guaranteed income covers your core expenditure. As we mentioned, the prevailing interest rate can have a big impact on annuity rates and in turn, the amount of income that you can get. So this will always be changing and a moving feast. However, to give you an idea of how much income you might be able to get from an annuity, let's see two examples. So annuity one, we're going to base this on a single life annuity that just has inflation protection. Annuity 2 is based on an annuity with 50% survivor pension that increases with inflation and has a 5-year guarantee. So you can see on the screen now how the extra frills of annuity can reduce the initial income amount from both options. Both examples assume this is for a £100,000 pension for a male age 66 and in good health. If your pension is more or less than 100,000, well, you can simply use the annuity rate as a percentage to calculate and apply that to what annuity you could get with your pension fund. But don't forget, and this is very important, annuity rates, they depend on loads of factors like the time you buy an annuity, your health, and the options that you choose with it. So just a word of warning, they will be different to what you can see on the screen earlier. If you want to learn more about drawdown, watch this video, which looks at it in more detail and some things that you may not be aware of with it.